Open a ZERODHA account. Chapter 7. Summarizing call and put options. Hindi Gujarati. 7.1 Remember these graphs. Over the last few chapters we have looked at two basic option types, i.e. the call option and the put option. Further, we looked at four different variants originating from these two options: buying a call option, selling a call option, buying a put option, selling a put option. With these four variants, a trader can create numerous different combinations and venture into some really efficient strategies, generally referred to as option strategies. Think of it this way: if you give a good artist a color palette and canvas, he can create some really interesting paintings. Similarly, a good trader can use these four option variants to create some really good trades. Imagination and intellect is the only requirement for creating these option trades. Hence, before we get deeper into options, it is important to have a strong foundation on these four variants of options. For this reason, we will quickly summarize what we have learned so far in this module. Please find below the payoff diagrams for the four different option variants. Arranging the payoff diagrams in the above fashion helps us understand a few things better. Let me list them for you. Let us start from the left side. If you notice, we have stacked the payoff diagram of call option, buy, and call option, sell, one below the other. If you look at the payoff diagram carefully, they both look like a mirror image. The mirror image of the payoff emphasizes the fact that the risk-reward characteristics of an option buyer and seller are opposite. The maximum loss of the call option buyer is the maximum profit of the call option seller. Likewise, the call option buyer has unlimited profit potential. Mirroring this, the call option seller has maximum loss potential. We have placed the payoff of call option, buy, and put option, sell, next to each other. This is to emphasize that both these option variants make money only when the market is expected to go higher. In other words, do not buy a call option or do not sell a put option when you sense there is a chance for the markets to go down. You will not make money doing so. Or in other words, you will certainly lose money in such circumstances. Of course, there is an angle of volatility here which we have not discussed yet. We will discuss the same going forward. The reason why I'm talking about volatility is because volatility has an impact on option premiums. Finally, on the right, the payoff diagram of put option, sell, and the put option, buy, are stacked one below the other. Clearly, the payoff diagrams looks like the mirror image of one another. The mirror image of the payoff emphasizes the fact that the maximum loss of the put option buyer is the maximum profit of the put option seller. Likewise, the put option buyer has unlimited profit potential. Mirroring this, the put option seller has maximum loss potential. Further, here is a table where the option positions are summarized. Your market view option type position, also called other alternatives premium: bullish call option, buy, long call, buy futures or buy spot pay. Flat or bullish put option, sell, short put, buy futures or buy spot receive. Flat or bearish call option, sell, short call, sell futures receive. Bearish put option, buy, long put, sell futures pay. It is important for you to remember that when you buy an option, it is also called long position. Going by that, buying a call option and buying a put option is called long call and long put position respectively. Likewise, whenever you sell an option, it is called short position. Going by that, selling a call option and selling a put option is also called short call and short put position respectively. Now here is another important thing to note. You can buy an option under two circumstances. You buy with an intention of creating a fresh option position. You buy with an intention to close an existing short position. The position is called long option only if you are creating a fresh buy position. If you are buying with an intention of closing an existing short position, then it is merely called a square off position. Similarly, you can sell an option under two circumstances. You sell with an intention of creating a fresh short position. You sell with an intention to close an existing long position. The position is called short option only if you are creating a fresh sell, writing an option position. If you are selling with an intention of closing an existing long position, then it is merely called a square-off position. 7.2 Option buyer in a nutshell. By now I'm certain you would have a basic understanding of the call and put option both from the buyer's and seller's perspective. However, I think it is best to reiterate a few key points before we make further progress in this module. Buying an option, call or put, makes sense only when we expect the market to move strongly in a certain direction. If fact, for the option buyer to be profitable, the market should move away from the selected strike price. Selecting the right strike price to trade is a major task. We will learn this at a later stage. For now, here are a few key points that you should remember. P&L long call upon expiry is calculated as P&L equals max 0. Spot price, strike price, premium paid. P&L long put upon expiry is calculated as P&L equals max 0. Strike price, spot price, premium paid. The above formula is applicable only when the trader intends to hold the long option till expiry. The intrinsic value calculation we have looked at in the previous chapters is only applicable on the expiry day. We cannot use the same formula during the series. The P&L calculation changes when the trader intends to square off the position well before the expiry. The buyer of an option has limited risk to the extent of premium paid. However, he enjoys an unlimited profit potential. 7.2 Option seller in a nutshell. The option sellers, call or put, are also called the option writers. The buyers and sellers have exact opposite P&L experience. Selling an option makes sense when you expect the market to remain flat or below the strike price, in case of calls, or above strike price in case of put option. I want you to appreciate the fact that all else equal, markets are slightly favorable to option sellers. This is because, for the option sellers to be profitable, the market has to be either flat or move in a certain direction based on the type of option. However, for the option buyer to be profitable, the market has to move in a certain direction. Clearly, there are two favorable market conditions for the option seller versus one favorable condition for the option buyer. But of course, this in itself should not be a reason to sell options. Here are a few key points you need to remember when it comes to selling options. P&L for a short call option upon expiry is calculated as P&L equals premium received, max 0. Spot price, strike price. P&L for a short put option upon expiry is calculated as P&L equals premium received, max 0. Strike price, spot price. Of course, the P&L formula is applicable only if the trader intends to hold the position till expiry. When you write options, margins are blocked in your trading account. The seller of the option has unlimited risk but very limited profit potential to the extent of the premium received. Perhaps this is the reason why Nassim Nicholas Taleb in his book, Fooled by Randomness, says, option writers eat like a chicken but shit like an elephant. This means to say that the option writers earn small and steady returns by selling options. But when a disaster happens, they tend to lose a fortune. Well, with this I hope you have developed a strong foundation on how a call and put option behaves. Just to give you a heads up, the focus going forward in this module will be on moneyness of an option, premiums, option pricing, option Greeks, and strike selection. Once we understand these topics, we will revisit the call and put option all over again. When we do so, I'm certain you will see the calls and puts in a new light and perhaps develop a vision to trade options professionally. 7.3 A quick note on premiums. Have a look at the snapshot below. This is the snapshot of how the premium has behaved on an intraday basis, the 30th of April 2015, for BHEL. The strike under consideration is 230 and the option type is a European call option, CE. This information is highlighted in the red box. Below the red box, I have highlighted the price information of the premium. If you notice, the premium of the 230 CE opened at 2 rupees and 25 paise, shot up to make a high of 8 rupees per and closed the day at 4 rupees and 5 paise per. Think about it. The premium has gyrated over 350% intraday, i.e., from 2 rupees and 25 paise per to 8 rupees per. And it roughly closed up 180% for the day, i.e. from 2 rupees and 25 paise per to 4 rupees and 5 paise per. Moves like this should not surprise you. These are fairly common to expect in the options world. Assume in this massive swing you managed to capture just 2 points while trading this particular option intraday. This translates to a sweet 2,000 rupees per in profits considering the lot size is 1,000, highlighted in green arrow. In fact, this is exactly what happens in the real world. Traders just trade premiums. Hardly any traders hold option contracts until expiry. Most of the traders are interested in initiating a trade now and squaring it off in a short while, intraday or maybe for a few days, and capturing the movements in the premium. They do not really wait for the options to expire. In fact, you might be interested to know that a return of 100% or so while trading options is not really a thing of surprise. But please don't just get carried away with what I just said. To enjoy such returns consistently, you need to develop a deep insight into options. Have a look at this snapshot. This is the option contract of Idea Cellular Limited. Strike price is 190. Expiry is on the 30th of April 2015 and the option type is a European call option. These details are marked in the blue box. Below this we can notice the OHLC data, which quite obviously is very interesting. The 190 CE premium opened the day at 8 rupees and 25 paise per and made a low of 30 paise per. I will skip the percent calculation simply because it is a ridiculous figure for intraday. However, assume you were a seller of the 190 call option intraday and you managed to capture just 2 points again, considering the lot size is 2,000. The 2-point capture on the premium translates to 4,000 rupees per in profits intraday. Good enough for that nice dinner at Marriott with your better half, Jay. The point that I'm trying to make is that traders, most of them, trade options only to capture the variations in premium. They don't really bother to hold till expiry. However, by no means I am suggesting that you need not hold until expiry. In fact, I do hold options till expiry in certain cases. Generally speaking, option sellers tend to hold contracts till expiry rather than option buyers. This is because if you have written an option for 8 rupees per, you will enjoy the full premium received, i.e. 8 rupees per only on expiry. So having said that, the traders prefer to trade just the premiums. You may have a few fundamental questions cropping up in your mind. Why do premiums vary? What is the basis for the change in premium? How can I predict the change in premiums? Who decides what should be the premium price of a particular option? Well, these questions and therefore the answers to these form the crux of option trading. If you can master these aspects of an option, let me assure you that you would set yourself on a professional path to trade options. To give you a heads up, the answers to all these questions lies in understanding the 4 forces that simultaneously exerts its influence on options premiums, as a result of which the premiums vary. Think of this as a ship sailing in the sea. The speed at which the ship sails, assume it's equivalent to the option premium, depends on various forces such as wind speed, seawater density, sea pressure, and the power of the ship. Some forces tend to increase the speed of the ship, while some tend to decrease the speed of the ship. The ship battles these forces and finally arrives at an optimal sailing speed. Likewise, the premium of the option depends on certain forces called as the option Greeks. Crudely put, some option Greeks tends to increase the premium, while some try to reduce the premium. A formula called the Black and Scholes option pricing formula employs these forces and translates the forces into a number, which is the premium of the option. Try and imagine this: the option Greeks influence the option premium, however the option Greeks itself are controlled by the markets, as the markets change on a minute-by-minute basis. Therefore, the option Greeks change and therefore the option premiums. Going forward in this module, we will understand each of these forces and its characteristics. We will understand how the force gets influenced by the markets and how the option Greeks further influences the premium. So the end objective here would be to get a sense of how the option Greeks influence premiums, to figure out how the premiums are priced considering option Greeks and their influence. Finally, keeping the Greeks and pricing in perspective, we need to smartly select strike prices to trade. One of the key things we need to know before we attempt to learn the option Greeks is to learn about the moneyness of an option. We will do the same in the next chapter. A quick note here, the topics going forward will get a little complex, although we will try our best to simplify it. While we do that, we would request you to please be thorough with all the concepts we have learned so far. Key takeaways from this chapter. Buy a call option or sell a put option only when you expect the market to go up. Buy a put option or sell a call option only when you expect the market to go down. The buyer of an option has an unlimited profit potential and limited risk to the extent of premium paid. The seller of an option has an unlimited risk potential and limited reward to the extent of premium received. Majority of option traders prefer to trade options only to capture the variation in premiums. Option premiums tend to gyrate drastically. As an options trader, you can expect this to happen quite frequently. Premiums vary as a function of four forces called the option Greeks. Black-Scholes option pricing formula employs four forces as inputs to give out a price for the premium. Markets control the option Greeks and the Greeks variation itself. 119 responses to Taki cannot access the selected text from this type of page. It is Taki cannot access the selected text from this type of page. Open a ZERODHA account. Chapter 8. Moneyness of an option contract. Hindu Gujarati. 8.1 Intrinsic value. The moneyness of an option contract is a classification method wherein each option strike gets classified as either in the money ITM, at the money ATM, or out of the money OTM option. This classification helps the trader to decide which strike to trade, given a particular circumstance in the market. However, before we get into the details, I guess it makes sense to look through the concept of intrinsic value again. The intrinsic value of an option is the money the option buyer makes from an options contract, provided he has the right to exercise that option on the given day. Intrinsic value is always a positive value and can never go below zero. Consider this example. Underlying CNX Nifty. Spot value 8,070. Option strike 8,050. Option type call option, C. Days to expiry 15. Position long. Given this, assume you bought the 8050 CE and instead of waiting for 15 days to expiry, you had the right to exercise the option today. Now my question to you is, how much money would you stand to make, provided you exercised the contract today? Do remember, when you exercise a long option, the money you make is equivalent to the intrinsic value of an option minus the premium paid. Hence, to answer the above question, we need to calculate the intrinsic value of an option, for which we need to pull up the call option intrinsic value formula from Chapter 3. Here is the formula. Intrinsic value of a call option equals spot price strike price. Let us plug in the values. Equals 8070, 8050. Equals 20. So, if you were to exercise this option today, you are entitled to make 20 points, ignoring the premium paid. Here is a table which calculates the intrinsic value for various option strike. These are just random values that I have used to drive across the concept. Option type strike spot formula intrinsic value remarks. Long call 280,310 spot price strike price 310 to 280 equals 30. Long put 1040980 strike price, spot price 1040 to 980 equals 60. Long call 920,918 spot price, strike price 918 to 920 equals 0 since IV cannot be VA. Long put 8088 strike price, spot price 8288 equals 0 since IV cannot be VA. With this, I hope you are clear about the intrinsic value calculation for a given option strike. Let me summarize a few important points. Intrinsic value of an option is the amount of money you would make if you were to exercise the option contract. Intrinsic value of an options contract can never be negative. It can be either 0 or a positive number. Call option intrinsic value equals spot price, strike price. Put option intrinsic value equals strike price, spot price. Before we wrap up this discussion, here is a question for you. Why do you think the intrinsic value cannot be a negative value? To answer this, let us pick an example from the above table. Strike is 920. Spot is 918. And option type is long call. Let us assume the premium for the 920 call option is 15 rupees. Now, if you were to exercise this option, what do you get? Clearly we get the intrinsic value. How much is the intrinsic value? Intrinsic value equals 918 to 920 equals minus 2. The formula suggests we get 2 rupees. What does this mean? This means 2 rupees is going from our pocket. Let us believe this is true for a moment. What will be the total loss? 15 plus 2 equals 17 rupees per. But we know the maximum loss for a call option buyer is limited to the extent of premium one pays. In this case it will be 15 rupees per. However, if we include a negative intrinsic value, this property of option payoff is not obeyed. 17 rupees per loss as opposed to 15 rupees per. Hence, in order to maintain the nonlinear property of option payoff, the intrinsic value can never be negative. You can apply the same logic to the put option intrinsic value calculation. Hopefully this should give you some insights into why the intrinsic value of an option can never go negative. 8.2 Moneyness of a call option. With our discussions on the intrinsic value of an option, the concept of moneyness should be quite easy to comprehend. Moneyness of an option is a classification method which classifies each option strike based on how much money a trader is likely to make if he were to exercise his option contract today. There are 3 broad classifications: in the money ITM, at the money ATM, out of the money OTM. And for all practical purposes, I guess it is best to further classify these as deep in the money, in the money ITM, at the money ATM, out of the money OTM, deep out of the money. Understanding these option strike classification is very easy. All you need to do is figure out the intrinsic value. If the intrinsic value is a non-zero number, then the option strike is considered in the money. If the intrinsic value is a 0, the option strike is called out of the money. The strike which is closest to the spot price is called at the money. Let us take up an example to understand this well. As of today, the 7th of May 2015, the value of Nifty is at 8,060. Keeping this in perspective, I've taken a snapshot of all the available strike prices, the same is highlighted within a blue box. The objective is to classify each of these strikes as ITM, ATM, or OTM. We will discuss the deep ITM and deep OTM later. As you can notice from the image above, the available strike prices trade starts from 7,100 all the way up to 8,700. We will first identify at the money option ATM, as this is the easiest to deal with. From the definition of ATM option that we posted earlier, we know ATM option is that option strike which is closest to the spot price. Considering the spot is at 8,060, the closest strike is probably 8,050. If there was 8,060 strike, then clearly 8,060 would be the ATM option. But in the absence of 8,060 strike, the next closest strike becomes ATM. Hence we classify 8,050 as The ATM option. Having established the ATM option 8050, we will proceed to identify ITM and OTM options. In order to do this, we will pick few strikes and calculate the intrinsic value. 7,100, 7,500, 8,050, 8,100, 8,300. Do remember the spot price is 8,060. Keeping this in perspective, the intrinsic value for the strikes above would be at 7,100. Intrinsic value equals 80607100 equals 960. Non-zero value. Hence the strike should be in the money ITM option at 7,500. Intrinsic value equals 80607500 equals 560. Non-zero value. Hence the strike should be in the money ITM option at 8,050. We know this is the ATM option as 8,050 strike is closest to the spot price of 8,060. So we will not bother to calculate its intrinsic value. At 8,100, intrinsic value equals 80608100 equals 40. Negative intrinsic value. Therefore, the intrinsic value is 0. Since the intrinsic value is 0, the strike is out of the money OTM at 8,300. Intrinsic value equals 80608300 equals 240. Negative intrinsic value. Therefore, the intrinsic value is 0. Since the intrinsic value is 0, the strike is out of the money OTM. You may have already sensed the generalizations for call options that exists here. However, allow me to restate the same again. All option strikes that are higher than the ATM strike are considered OTM. All option strikes that are below the ATM strike are considered ITM. In fact, I would suggest you relook at the snapshot we just posted. NSE presents ITM options with a pale yellow background and all OTM options have a regular white background. Now let us look at two ITM options 7,500 and 8,000. The intrinsic value works out to be 560 and 60 respectively, considering the spot is at 8,060. Higher the intrinsic value, deeper the moneyness of the option. Therefore 7,500 strike is considered as deep in the money option and 8,000 is just in the money option. I would encourage you to observe the premiums for all these strike prices, highlighted in green box. Do you sense a pattern here? The premium decreases as you traverse from deep ITM option to deep OTM option. In other words, ITM options are always more expensive compared to OTM options. 8.3 Moneyness of a put option. Let us run through the same exercise to find out how strikes are classified as ITM and OTM for put options. Here is the snapshot of various strikes available for a put option. The strike prices on the left are highlighted in a blue box. Do note at the time of taking the snapshot, the 8th of May 2015, Nifty's spot value is 8,202. As you can see, there are many strike prices available right from 7,100 to 8,700. We will first classify the ATM option and then proceed to identify ITM and OTM option. Since the spot is at 8,202, the nearest strike to spot should be the ATM option. As we can see from the snapshot above, there is a strike at 8,200 which is trading at 131 rupees and 35 paise per. This obviously becomes the ATM option. We will now pick a few strikes above and below the ATM and figure out ITM and OTM options. Let us go with the following strikes and evaluate their respective intrinsic value, also called the Moneyness. 7,500, 8,000, 8,200, 8,300, 8,500. At 7,500, we know the intrinsic value of put option can be calculated as equals strike, spot. Intrinsic value equals 75008200 equals 700. Negative intrinsic value. Therefore, the option is OTM. At 8,000. Intrinsic value equals 8,8200 equals 200. Negative intrinsic value. Therefore, the option is OTM. at 8,200. 8,200 is already classified as ATM option. Hence we will skip this and move ahead. At 8,300. Intrinsic value equals 8300, 8200. Equals plus 100. Positive intrinsic value. Therefore the option is ITM. At 8,500. Intrinsic value equals 8500, 8200. Equals plus 300. Positive intrinsic value. Therefore the option is ITM. Hence, an easy generalization for put options are: all strikes higher than ATM options are considered ITM. All strikes lower than ATM options are considered OTM. And as you can see from the snapshot, the premiums for ITM options are much higher than the premiums for the OTM options. I hope you have got a clear understanding of how option strikes are classified based on their moneyness. However, you may still be wondering about the need to classify options based on their moneyness. Well, the answer to this lies in option Greeks again. As you briefly know by now, option Greeks are the market forces which act upon option strikes and therefore affect the premium associated with these strikes. So a certain market force will have a certain effect on ITM option while at the same time it will have a different effect on an OTM option. Hence classifying the option strikes will help us in understanding the option Greeks and their impact on the premiums better. 8.4 The option chain. The option chain is a common feature on most of the exchanges and trading platforms. The option chain is a ready reckoner of sorts that helps you identify all the strikes that are available for a particular underlying and also classifies the strikes based on their moneyness. Besides, the option chain also provides information such as the premium price, LTP, bid-ask price, volumes, open interest, etc. for each of the option strikes. Have a look at the option chain of Ashoka Leyland Limited as published on NSE. Few observations to help you understand the option chain better. The underlying spot value is at 68 rupees and 70 paise per, highlighted in blue. The call options are on to the left side of the option chain. The put options are on to the right side of the option chain. The strikes are stacked on an increasing order in the center of the option chain. Considering the spot at 68 rupees and 70 paise, the closest strike is 67.5. Hence that would be an ATM option, highlighted in yellow. For call options, all option strikes lower than ATM options are ATM option. Hence they have a pale yellow background. For call options, all option strikes higher than ATM options are OTM options. Hence they have a white background. For put options, all option strikes higher than ATM are ATM options. Hence they have a pale yellow background. For put options, all option strikes lower than ATM are OTM options. Hence they have a white background. The pale yellow and white background from NSE is just a segregation method to bifurcate the ITM and OTM options. The color scheme is not a standard convention. Here is the link to check the option chain for Nifty options. 8.4 The way forward. Having understood the basics of the call and put options both from the buyers and sellers' perspective and also having understood the concept of ITM, OTM, and ATM, I suppose we are all set to dwell deeper into options. The next couple of chapters will be dedicated to understand option Greeks and the kind of impact they have on option premiums. Based on the option Greeks' impact on the premiums, we will figure out a way to select the best possible strike to trade for a given circumstance in the market. Further, we will also understand how options are priced by briefly running through the Black and Scholes option pricing formula. The Black and Scholes option pricing formula will help us understand things like why Nifty 8,200 is trading at 131 and not 152 or 102. I hope you are as excited to learn about all these topics as we are to write about the same. So please stay tuned. Onwards to option Greeks now. Key takeaways from this chapter. The intrinsic value of an option is equivalent to the value of money the option buyer makes, provided if he were to exercise the contract. Intrinsic value of an option cannot be negative. It is a non-zero positive value. Intrinsic value of call option equals spot price strike price. Intrinsic value of put option equals strike price spot price. Any option that has an intrinsic value is classified as in the money ITM option. Any option that does not have an intrinsic value is classified as out of the money OTM option. If the strike price is almost equal to spot price, then the option is considered as at the money ATM option. All strikes lower than ATM are ATM options for call options. All strikes higher than ATM are OTM options for call options. All strikes higher than ATM are ATM options for put options. All strikes lower than ATM are OTM options for put options. When the intrinsic value is very high, it is called deep ITM option. Likewise, when the intrinsic value is the least, it is called deep OTM option. The premiums for ITM options are always higher than the premiums for OTM option. The option chain is a quick visualization to understand which option strike is ITM, OTM, ATM for both calls and puts, along with other information relevant to options. 108 responses to money. Open a ZERODHA account. Chapter 9. The Option Greeks, Delta, Part 1. Hindu Gujarati. 9.1 Overview. Yesterday I watched the latest Bollywood flick, Pika. Quite nice, I must say. After watching the movie, I was casually pondering over what really made me like Pika. Was it the overall storyline? Or Amitabh Bachchan's brilliant acting? Or Deepika Padukone's charming screen presence? Or Shujit Sarkar's brilliant direction? Well, I suppose it was a mix of all these factors that made the movie enjoyable. This also made me realize there is a remarkable similarity between a Bollywood movie and an options trade. Similar to a Bollywood movie, for an options trade to be successful in the market, there are several forces which need to work in the option trader's favor. These forces are collectively called the option Greeks. These forces influence an option contract in real time, affecting the premium to either increase or decrease on a minute-by-minute basis. To make matters complicated, these forces not only influence the premiums directly but also influence each another. To put this in perspective, think about these two Bollywood actors, Aamir Khan and Salman Khan. Movie buffs would recognize them as two independent acting forces similar to option Greeks of Bollywood. They can independently influence the outcome of the movie they act in. Think of the movie as an options premium. However, if you put both these guys in a single flick, chances are that they will try to pull one another down while at the same time push themselves up, and at the same time try to make the movie a success. Do you see the juggling around here? This may not be a perfect analogy, but I hope it gives you a sense of what I'm trying to convey. Options premiums, options Greeks, and the natural demand-supply situation of the markets influence each other. Though all these factors work as independent agents, yet they are all intervened with one another. The final outcome of this mixture can be assessed in the options premium. For an options trader, assessing the variation in premium is most important. He needs to develop a sense for how these factors play out before setting up an option trade. So without much ado, let me introduce the Greeks to you. Delta measures the rate of change of options premium based on the directional movement of the underlying gamma, rate of change of delta itself. Vega, rate of change of premium based on change in volatility. Theta measures the impact on premium based on time left for expiry. We will discuss these Greeks over the next few chapters. The focus of this chapter is to understand the delta. 9.2 Delta of an option. Notice the following two snapshots here. They belong to Nifty's 8250 CE option. The first snapshot was taken at 9:18 a.m. when Nifty's spot was at 8,292. A little while later. Now notice the change in premium. At 9:18 a.m. when Nifty was at 8,292, the call option was trading at 144. However, at 10 a.m. Nifty moved to 8,315 and the same call option was trading at 150. In fact, here is another snapshot at 10:55 a.m. Nifty declined to 8,288 and so did the option premium. Declined to 133. From the above observations, one thing stands out very clear, as in when the value of the spot changes, so does the option premium. More precisely, as we already know, the call option premium increases with the increase in the spot value and vice versa. Keeping this in perspective, imagine this: you have predicted that Nifty will reach 8,355 by 3 p.m. today. From the snapshots above, we know that the premium will certainly change, but by how much? What is the likely value of the 8250 CE premium if Nifty reaches 8,355? Well, this is exactly where the delta of an option comes handy. The delta measures how an option's value changes with respect to the change in the underlying. In simpler terms, the delta of an option helps us answer questions of this sort: by how many points will the option premium change for every 1 point change in the underlying. Therefore, the option Greek's delta captures the effect of the directional movement of the market on the option's premium. The delta is a number which varies between 0 and 1 for a call option. Some traders prefer to use the 0 to 100 scale. So the delta value of 0.55 on 0 to 1 scale is equivalent to 55 on the 0 to 100 scale. Between -1 and 0, -100 to 0 for a put option. So the delta value of -0.4 on the -1 to 0 scale is equivalent to -40 on the -100 to 0 scale. We will soon understand why the put option's delta has a negative value associated with it. At this stage, one want to give you an orientation of how this chapter will shape up. Please do keep this at the back of your mind, as I believe it will help you join the dots better. We will understand how we can use the delta value for call options. A quick note on how the delta values are arrived at. Understand how we can use the delta value for put options. Delta characteristics, delta versus spot. Delta acceleration, continued in next chapter. Option positions in terms of delta, continued in next chapter. So let's hit the road. 9.3 Delta for a call option. We know that delta is a number that ranges between 0 and 1. Assume a call option has a delta of 0.3 or 30. What does this mean? Well, as we know, the delta measures the rate of change of premium for every unit change in the underlying. So a delta of 0.3 indicates that for every 1 point change in the underlying, the premium is likely to change by 0.3 units. Or for every 100 point change in the underlying, the premium is likely to change by 30 points. The following example should help you understand this better. Nifty at 10:55 a.m. is at 8,288. Option strike equals 8,250. Call option premium equals 133. Delta of the option equals plus 0.55. Nifty at 3:15 p.m. is expected to reach 8,310. What is the likely option premium value at 3:15 p.m.? Well, this is fairly easy to calculate. We know the delta of the option is 0.55, which means for every 1 point change in the underlying, the premium is expected to change by 0.55 points. We are expecting the underlying to change by 22 points, 8310.8288. Hence the premium is supposed to increase by equals 22 asterisk 0.55 equals 12.1. Therefore, the new option premium is expected to trade around 145.1, 133 plus 12.1, which is the sum of old premium plus expected change in premium. Let us pick another case. What if one anticipates a drop in Nifty? What will happen to the premium? Let us figure that out. Nifty at 10:55 a.m. is at 8,288. Option strike equals 8,250. Call option premium equals 133. Delta of the option equals 0.55. Nifty at 3:15 p.m. is expected to reach 8,200. What is the likely premium value at 3:15 p.m.? We are expecting Nifty to decline by 88 points, 8200-8288. Hence the change in premium will be equals 88 asterisk 0.55 equals 48.4. Therefore, the premium is expected to trade around equals 133 to 48.4 equals 84.6 new premium value. As you can see from the above two examples, the delta helps us evaluate the premium value based on the directional move in the underlying. This is extremely useful information to have while trading options. For example, assume you expect a massive 100-point up move on Nifty, and based on this expectation you decide to buy an option. There are two call options and you need to decide which one to buy. Call option 1 has a delta of 0.05. Call option 2 has a delta of 0.2. Now the question is, which option will you buy? Let us do some math to answer this. Change in underlying equals 100 points. Call option 1 delta equals 0.05. Change in premium for call option 1 equals 100 asterisk 0.05 equals 5. Call option 2 delta equals 0.2. Change in premium for call option 2 equals 100 asterisk 0.2 equals 20. As you can see, the same 100-point move in the underlying has different effects on different options. In this case, clearly the trader would be better off buying call option 2. This should give you a hint. The delta helps you select the right option strike to trade. But of course there are more dimensions to this, which we will explore soon. At this stage, let me post a very important question. Why is the delta value for a call option bound by 0 and 1? Why can't the call option's delta go beyond 0 and 1? To help understand this, let us look at two scenarios wherein I will purposely keep the delta value above 1 and below 0. Scenario 1. Delta greater than 1 for a call option. Nifty at 10:55 a.m. at 8,268. Option strike equals 8,250. Call option. Premium equals 133. Delta of the option equals 1.5, purposely keeping it above 1. Nifty at 3:15 p.m. is expected to reach 8,310. What is the likely premium value at 3:15 p.m.? Change in Nifty equals 42 points. Therefore, the change in premium, considering the delta is 1.5, equals 1.5 asterisk 42 equals 63. Do you notice that? The answer suggests that for a 42-point change in the underlying, the value of premium is increasing by 63 points. In other words, the option is gaining more value than the underlying itself. Remember, the option is a derivative contract. It derives its value from its respective underlying. Hence, it can never move faster than the underlying. If the delta is 1, which is the maximum delta value, it signifies that the option is moving in line with the underlying, which is acceptable. But a value higher than 1 does not make sense. For this reason, the delta of an option is fixed to a maximum value of 1 or 100. Let us extend the same logic to figure out why the delta of a call option is lower, bound to 0. Scenario 2. Delta lesser than 0 for a call option. Nifty at 10:55 a.m. at 8,288. Option strike equals 8,300. Call option. Premium equals 9. Delta of the option equals 0.2. Have purposely changed the value to below 0. Hence negative delta. Nifty at 3:15 p.m. is expected to reach 8,200. What is the likely premium value at 3:15 p.m.? Change in Nifty equals 88 points, 8288-8200. Therefore, the change in premium, considering the delta is minus 0.2, equals minus 0.2 asterisk 88 equals minus 17.6. For a moment, we will assume this is true. Therefore, new premium will be equals minus 17.6 plus 9 equals 8.6. As you can see in this case, when the delta of a call option goes below 0, there is a possibility for the premium to go below 0, which is impossible. At this point, do recollect the premium, irrespective of a call or put, can never be negative. Hence, for this reason, The delta of a call option is lower bound to 0. 9.4 Who decides the value of the delta? The value of the delta is one of the many outputs from the Black and Scholes option pricing formula. As I have mentioned earlier in this module, the B&S formula takes in a bunch of inputs and gives out a few key outputs. The output includes the option's delta value and other Greeks. After discussing all the Greeks, we will also go through the B&S formula to strengthen our understanding on options. However, for now, you need to be aware that the delta and other Greeks are market-driven values and are computed by the B&S formula. However, here is a table which will help you identify the approximate delta value for a given option. Dash. Option type approximately delta value C. Approximately delta value pay. D by TM between plus 0.8 to plus 1 between 0.8 to 1. Slightly ITM between plus 0.6 to plus 1 between 0.6 to 1. ATM between plus 0.45 to plus 0.55 between 0.45 to 0.55. Slightly OTM between plus 0.45 to plus 0.3 between 0.45 to minus 0.3. Deep OTM between plus 0.3 to plus 0 between 0.3 to 0. Of course, you can always find out the exact delta of an option by using a B&S option pricing calculator. 9.5 Delta for a put option. Do recollect the delta of a put option ranges from -1 to 0. The negative sign is just to illustrate the fact that when the underlying gains in value, the value of premium goes down. Keeping this in mind, consider the following details. Parameters values. Underlying Nifty. Strike 8,300. Spot value 8,268. Premium 128. Delta minus 0.55. Expected Nifty value, case 1, 8,310. Expected Nifty value, case 2, 8,230. Note the 8,268 is a slightly ITM option. Hence the delta is around minus 0.55 as indicated from the table above. The objective is to evaluate the new premium value considering the delta value to be minus 0.55. Do pay attention to the calculations made below. Case 1. Nifty is expected to move to 8,310. Expected change equals 8310.8268. Equals 42. Delta equals 0.55. Equals minus 0.55 asterisk 42. Equals minus 23.1. Current premium equals 128. New premium equals 128 to 23.1. Equals 104.9. Here I'm subtracting the value of delta since I know that the value of a put option declines when the underlying value increases. Case 2. Nifty is expected to move to 8,230. Expected change equals 8268.8230. Equals 38. Delta equals 0.55. Equals minus 0.55 asterisk 38. Equals minus 20.9. Current premium equals 128. New premium equals 128 plus 20.9. Equals 148.9. Here I'm adding the value of delta since I know that the value of a put option gains when the underlying value decreases. I hope with the above two illustrations you are now clear on how to use the put option's delta value to evaluate the new premium value. Also, I will take the liberty to skip explaining why the put option's delta is bound between -1 and 0. In fact, I would encourage the readers to apply the same logic we used while understanding why the call option's delta is bound between 0 and 1. To understand why put option's delta is bound between -1 and 0. In the next chapter we will dig deeper into delta and understand some of its characteristics. Key takeaways from this chapter. Option Greeks are forces that influence the premium of an option. Delta is an option Greek that captures the effect of the direction of the market. Call option delta varies between 0 and 1. Some traders prefer to use 0 to 100. Put option delta varies between -1 and 0, -100 to 0. The negative delta value for a put option indicates that the option premium and underlying value moves in the opposite direction. ATM options have a delta of 0.5. ITM option have a delta of close to 1. OTM options have a delta of close to 0. 133. Open a ZERODHA account. Chapter 10. Delta, Part 2. Hindu Gujarati. 10.1 Model Thinking. The previous chapter gave you a sneak peek into the first option Greek, the delta. Besides discussing the delta, there was another hidden agenda in the previous chapter to set you on a model thinking path. Let me explain what I mean by this. The previous chapter opened up a new window to evaluate options. The window threw open different option trading perspectives. Hopefully you now no longer think about options in a one-dimensional perspective. For instance, going forward, if you have view on markets, bullish for example, you may not strategize your trade this way. My view is bullish. Therefore, it makes sense to either buy a call option or collect premium by selling a put option. Rather, you may strategize this way. My view is bullish as I expect the market to move by 40 points. Therefore, it makes sense to buy an option which has a delta of 0.5 or more, as the option is expected to gain at least 20 points for the given 40-point move in the market. See the difference between the two thought processes? While the former is a bit naive and casual, the latter is well-defined and quantitative in nature. The expectation of a 20-point move in the option premium was an outcome of a formula that we explored in the previous chapter. Expected change in option premium equals option delta asterisk points change in underlying. The above formula is just one piece in the whole game plan. As and when we discover the other Greeks, the evaluation metric becomes more quantitative, and in the process the trade selection becomes more scientifically streamlined. Point is, the thinking going forward will be guided by equations and numbers, and casual trading thoughts will have very little scope. I know there are many traders who trade just with a few random thoughts, and some may even be successful. However, this is not everybody's cup of tea. The odds are better when you put numbers in perspective, and this happens when you develop model thinking. So please do keep model thinking framework in perspective while analyzing options, as this will help you set up systematic trades. 10.2 Delta versus spot price. In the previous chapter we looked at the significance of delta and also understood how one can use delta to evaluate the expected change in premium. Before we proceed any further, here is a quick recap from the previous chapter. Call options has a plus pay delta. A call option with a delta of 0.4 indicates that for every 1 point gain, loss in the underlying, the call option premium gains losses 0.4 points. Put options has a V delta. A put option with a delta of -0.4 indicates that for every 1 point loss gain in the underlying, the put option premium gains losses 0.4 points. OTM options have a delta value between 0 and 0.5. ATM option has a delta of 0.5. And ITM option has a delta between 0.5 and 1. Let me take cues from the third point here and make some deductions. Assume Nifty spot is at 8,312. Strike under consideration is 8,400. And option type is CE, call option. European. What is the approximate delta value for the 8400 CE when the spot is 8,312? Delta should be between 0 and 0.5 as 8400 says OTM. Let us assume delta is 0.4. Assume Nifty spot moves from 8,312 to 8,400. What do you think is the delta value? Delta should be around 0.5 as the 8400 is now in a TM option. Further, assume Nifty spot moves from 8,400 to 8,500. What do you think is the delta value? Delta should be closer to 1 as the 8400 is now an ITM option. Let us say 0.8. Finally, assume Nifty spot cracks heavily and drops back to 8,300 from 8,500. What happens to Delta? With the fall in spot, the option has again become an OTM from ITM. Hence the value of Delta also falls from 0.8 to, let us say, 0.35. What can you deduce from the above 4 points? Clearly, as and when the spot value changes, the moneyness of an option changes, and therefore the delta also changes. Now this is a very important point here. The delta changes with changes in the value of spot. Hence delta is a variable and not really a fixed entity. Therefore, if an option has a delta of 0.4, the value is likely to change with the change in the value of the underlying. Have a look at the chart below. It captures the movement of delta versus the spot price. The chart is a generic one and not specific to any particular option or strike as such. As you can see, there are two lines. The blue line captures the behavior of the call options. Delta varies from 0 to 1. The red line captures the behavior of the put options. Delta varies from -1 to 0. Let us understand this better. This is a very interesting chart. And to begin with, I would suggest you look at only the blue line and ignore the red line completely. The blue line represents the delta of a call option. The graph above captures few interesting characteristics of the delta. Let me list them for you. Meanwhile, keep this point in the back of your mind, as and when the spot price changes, the moneyness of the option also changes. Look at the x-axis. Starting from left, the moneyness increases as the spot price traverses from OTM to ATM to ITM. Look at the delta line, blue line. As and when the spot price increases, so does the delta. Notice at OTM the delta is flattish near zero. This also means irrespective of how much the spot price falls, going from OTM to deep OTM, the option's delta will remain at zero. Remember, the call option's delta is lower bound by zero. When the spot moves from OTM to ATM, the delta also starts to pick up. Remember, the option's moneyness also increases. Notice how the delta of option lies within 0 to 0.5 range for options that are less than ATM. At ATM, the delta hits a value of 0.5. When the spot moves along from the ATM towards ITM, the delta starts to move beyond the 0.5 mark. Notice the delta starts to fatten out when it hits a value of 1. This also implies that as and when the delta moves beyond ITM to, say, deep ITM, the delta value does not change. It stays at its maximum value of 1. You can notice similar characteristics for the put option's delta, red line. 10.3 The delta acceleration. If you are fairly involved in the options world, you may have heard of bizarre stories of how traders double or triple their money by trading OTM option. If you have not heard such stories, let me tell you one. It was the 17th of May 2009, Sunday. The election results were declared. The UPA government got re-elected at the center and Dr. Manmohan Singh came back as the country's Prime Minister to serve his second term. Stock markets like stability at the center, and we all knew that the market would rally the next day, i.e., the 18th of May 2009. The previous day, Nifty had closed at 3,671. Zeroda was not born then. We were just a bunch of traders trading our own capital along with a few clients. One of our associates had taken a huge risk few days prior to the 17th of May. He bought far-off options OTM worth 200,000 rupees per. A daredevil act. This was considering the fact that nobody can really predict the outcome of a general election. Obviously, he would benefit if the market rallied. But for the market to rally, there were many factors at play. Along with him, we too were very anxious to figure out what would happen. Finally, the results were declared and we all knew he would make money on the 18th of May, but none of us really knew to what extent he would stand to benefit. The 18th of May 2009. A day that I cannot forget. Markets opened at 9:55 a.m. That was the market opening time back then. It was a big bang open for market. Nifty immediately hit an upper circuit and the markets froze. Within a matter of few minutes, Nifty rallied close to 20% to close the day at 4,321. The exchanges decided to close the market at 10:01 a.m. as it was overheated, and thus it was the shortest working day of my life. Here is the chart that highlights that day's market move. In the whole process, our dear associate had made a sweet fortune. At 10:01 a.m. on that glorious Monday morning, his options were valued at 28 rupees, a whopping 1,300% gain, all achieved overnight. This is the kind of trades that almost all traders, including me, aspire to experience. Anyway, let me ask you a few questions regarding this story, and that will also bring us back to the main topic. Why do you think our associate chose to buy OTM options and not really ATM or ITM options? What would have happened if he had bought an ITM or ATM option instead? Well, the answers to these questions lies in this graph. This graph talks about the delta acceleration. There are 4 delta stages mentioned in the graph. Let us look into each one of them. Before we move ahead with the following to discussion, some points for you here. I would advise you to pay a lot of attention to the following to discussion. These are some of the really important points to know and remember. Do recollect and revise the delta table, option type, approximate delta value, etc. from the previous chapter. Please do bear in mind the delta and premium numbers used here is an intelligent assumption for the sake of this illustration. Pre-development. This is the stage when the option is OTM or deep OTM. The delta here is close to 0. The delta will remain close to 0 even when the option moves from deep OTM to OTM. For example, when spot is 8,400, 8,700 call option is deep OTM, which is likely to have a delta of 0.05. Now, even if the spot moves from 8,400 to, let us say, 8,500, the delta of 8,700 call option will not move much, as 8,700 CE is still an OTM option. The delta will still be a small non-zero number. So if the premium for 8,700 CE when spot is at 8,400 is 12 rupees, then when Nifty moves to 8,500, 100 point move, the premium is likely to move by 100 * 0.05 equals 5 points. Hence the new premium will be 12 rupees plus 5 equals 17 rupees per. However, the 8,700s is now considered slightly OTM and not really deep OTM. Most important to note, the change in premium value in absolute terms may be small, 5 rupees per, but in percentage terms the 12 rupees per option has changed by 41.6% to 17 rupees per. Conclusion: deep OTM options tends to put on an impressive percentage. However, for this to happen, the spot has to move by a large value. Recommendation: avoid buying deep OTM options because the deltas are really small and the underlying has to move massively for the option to work in your favor. There is more bang for the buck elsewhere. However, for the very same reason, selling deep OTM makes sense. But we will evaluate when to sell these options when we take up the Greek theta takeoff and acceleration. This is the stage when the option transitions from OTM to ATM. This is where the maximum bang for the buck lies, and therefore the risk. Consider this Nifty spot at 8,400. Strike is 8,500 CE. Option is slightly OTM. Delta is 0.25. Premium is 20 rupees per. Spot moves from 8,400 to 8,500, 100 point. To figure out what happens on the premium side, let us do some math. Change in underlying equals 100. Delta for 8,500 CE equals 0.25. Premium change equals 100 * 0.25 equals 25. New premium equals 20 rupees plus 25 equals 45 rupees per. Percentage change equals 125%. Do you see that? For the same 100-point move, slightly OTM options behaves very differently. Conclusion: the slightly OTM option, which usually has a delta value of say 0.2 or 0.3, is more sensitive to changes in the underlying. For any meaningful change in the underlying, the percentage change in the slightly OTM options is very impressive. In fact, this is exactly how option traders double or triple their money, i.e., by buying slightly OTM options when they expect big moves in the underlying. But I would like to remind you that this is just one face of the cube. There are other faces we still need to explore. Recommendation: buying slightly OTM option is more expensive than buying deep OTM options. But if you get your act right, you stand to make a killing. Whenever you buy options, consider buying slightly OTM options, of course assuming there is plenty of time to expiry. We will talk about this later. Let us take this forward and see how the ATM option would react for the same 100-point move. Spot equals 8,400. Strike equals 8,400. ATM. Premium equals 60 rupees per. Change in underlying equals 100. Delta for 8,400 CE equals 0.5. Premium change equals 100 asterisk 0.5 equals 50. New premium equals 60 rupees plus 50 equals 110 rupees per. Percentage change equals 83%. Conclusion: ATM options are more sensitive to changes in the spot when compared to OTM options. Now, because the ATM's delta is high, the underlying need not really move by a large value. Even if the underlying moves by a small value, the option premium changes. However, buying ATM options are more expensive when compared to OTM options. Recommendation: buy ATM options when you want to play safe. The ATM option will move even if the underlying does not move by a large value. Also, as a corollary, do not attempt to sell an ATM option unless you are very sure about what you are doing. Stabilization: when the option transitions from ATM to ITM and deep ITM, the delta starts to stabilize at 1. As we can see from the graph, the delta starts to flatten out when hits the value of 1. This means the option can be ITM or deep ITM, but the delta gets fixed to 1 and would not change in value. Let us see how this works. Nifty spot equals 8,400. Option 1 equals 8,300 CE strike. ITM option. Delta of 0.8. And premium is 105 rupees. Option 2 equals 8,200 CE strike. Deep ITM option. Delta of 1.0. And premium is 210 rupees. Change in underlying equals 100 points. Hence Nifty moves to 8,500. Given this, let us see how the two options behave. Change in premium for option 1 equals 100 asterisk 0.8 equals 80. New premium for option 1 equals 105 rupees plus 80 equals 185 rupees per. Percentage change equals 80 105 equals 76.19%. Change in premium for option 2 equals 100 asterisk 1 equals 100. New premium for option 2 equals 210 rupees plus 100 equals 310 rupees per. Percentage change equals 100 210 equals 47.6%. Conclusion: in terms of the absolute change in the number of points, the deep ITM option scores over the slightly ITM option. However, in terms of percentage change, it is the other way round. Clearly, ITM options are more sensitive to the changes in the underlying, but certainly most expensive. Most importantly, notice the change in the deep ITM option, delta 1, for a change of 100 points in the underlying. There is a change of 100 points in the option premium. This means to say when you buy a deep ITM option, it is as good as buying the underlying itself. This is because whatever is the change in the underlying, the deep ITM option will experience the same change. Recommendation: buy the ITM options when you want to play very safe. When I say safe, I'm contrasting the deep ITM option with deep OTM option. The ITM options have a high delta, which means they are most sensitive to changes in the underlying. Deep ITM option moves in line with the underlying. This means you can substitute a deep ITM option to a futures contract. Think about this. Nifty spot at 8,400. Nifty futures equals 8,409. Strike equals 8,000. Deep ITM. Premium equals 450. Delta equals 1.0. Change in spot equals 30 points. New spot value equals 8,430. Change in futures equals 8,409 plus 30 equals 8,439. It reflects the entire 30-point change. Change option premium equals 1 asterisk 30 equals 30. New option premium equals 30 plus 450 equals 480. It reflects the entire 30-point change. So, the point is, both futures and deep ITM options react very similar to the changes in the underlying. Hence, you are better off buying a deep ITM option and therefore lessen your margin burden. However, if you opt to do this, you need to constantly make sure that the deep ITM option continues to remain deep ITM. In other words, make sure the delta is always 1. Plus, do keep an eye on the liquidity of the contract. I would suspect that at this stage the information contained in this chapter could be an overdose, especially if you are exploring the Greeks for the first time. I would suggest you take your time to learn this one bit at a time. There are a few more angles we need to explore with respect to the delta, but we'll do that in the next chapter. However, before we conclude this chapter, let us summarize the discussion with the help of a table. This table will help us understand how different options behave differently given a certain change in the underlying. I've considered Bajaj Auto as the underlying. The price is 2,210 and the expectation is a 30-point change in the underlying, which means we are expecting Bajaj Auto to hit 2,240. We will also assume there is plenty of time to expiry. Hence, time is not really a concern. Moneyness strike delta old premium change in premium new premium percent change. Deep OTM 2,400 0.053 rupees per 30 asterisk 0.05 equals 1.53 plus 1.5 equals 4.5 50%. Slightly OTM 2,275 0.37 rupees per 30 asterisk 0.3 equals 97 plus 9 equals 16,129%. ATM 2,210 0.512 rupees per 30 asterisk 0.5 equals 1512 plus 15 equals 27,125%. Slightly ITM 2,200 0.722 rupees per 30 asterisk 0.7 equals 2122 plus 21 equals 4395.45%. Deep ITM 2,151 75 rupees per 30 asterisk 1 equals 3075 plus 30 equals 105 40%. As you can see, each option behaves differently for the same move in the underlying. Before I wrap this chapter, I narrated a story to you earlier in this chapter, following which I posted few questions. Perhaps you can now revisit the questions and you will hopefully know the answers. Key takeaways from this chapter. Model thinking helps in developing a scientifically streamlined approach to trading. The delta changes as and when the spot value changes. As the option transitions from OTM to ATM to ITM, so does the delta. Delta hits a value of 0.5 for ATM options. Delta pre-development is when the option transitions from deep OTM to OTM. Delta takeoff and acceleration is when the option transitions from OTM to ATM. Open a ZERODHA account. Chapter 11. Delta, Part 3. Hindu Gujarati. 11.1 Add up the deltas. Here is an interesting characteristic of the delta. The deltas can be added up. Let me explain. We will go back to the futures contract for a moment. We know for every point change in the underlying spot value, the futures also changes by 1 point. For example, if Nifty spot moves from 8,340 to 8,350, then the Nifty futures will also move from 8,347 to 8,357, i.e., assuming Nifty futures is trading at 8,347 when the spot is at 8,340. If we were to assign a delta value to futures, clearly the futures delta would be 1, as we know for every 1 point change in the underlying the futures also changes by 1 point. Now, assume I buy one ATM option which has a delta of 0.5. Then we know that for every 1 point move in the underlying, the option moves by 0.5 points. In other words, owning one ATM option is as good as holding half futures contract. Given this, if I hold 2 such ATM contracts, then it is good as holding 1 futures contract, because the delta of the 2 ATM options, i.e. 0.5 and 0.5, which adds up to total delta of 1. In other words, the deltas of 2 or more option contracts can be added to evaluate the total delta of the position. Let us take up a few case studies to understand this better. Case 1, Nifty spot at 8,125. Trader has 3 different call option. SL no contract classification lots delta position delta. 1. 8,000 CE ITM 1 by 0.7 plus 1 asterisk 0.7 equals plus 0.7. 2. 8120 CE ATM 1 by 0.5 plus 1 asterisk 0.5 equals plus 0.5. 3. 8300 CE Depot TM 1 by 0.05 plus 1 asterisk 0.05 equals plus 0.05. Total delta of positions equals 0.7 plus 0.5 plus 0.05 equals plus 1.25. Observations. The positive sign next to 1 in the position delta column indicates long position. The combined positions have a positive delta, i.e. plus 1.25. This means both the underlying and the combined position moves in the same direction. For every 1 point change in Nifty, the combined position changes by 1.25 points. If Nifty moves by 50 points, the combined position is expected to move by 50 asterisk 1.25 equals 62.5 points. Case 2, Nifty spot at 8,125. Trader has a combination of both call and put options. SL no contract classification lots delta position delta. 1. 8,000 CE ITM 1 by 0.7 plus 1 asterisk 0.7 equals 0.7. 2. 8300 pay deep ITM 1 by 1.0 plus 1 asterisk minus 1.0 equals minus 1.0. 3. 8120 CE ATM 1 by 0.5 plus 1 asterisk 0.5 equals 0.5. 4. 8300 CE Depot TM 1 by 0.05 plus 1 asterisk 0.05 equals 0.05. Total delta of positions 0.7 to 1.0 plus 0.5 plus 0.05 equals plus 0.25. Observations. The combined positions have a positive delta, i.e. plus 0.25. This means both the underlying and the combined position move in the same direction. With the addition of deep ITM pay, the overall position delta has reduced. This means the combined position is less sensitive to the directional movement of the market. For every 1 point change in Nifty, the combined position changes by 0.25 points. If Nifty moves by 50 points, the combined position is expected to move by 50 asterisk 0.25 equals 12.5 points. Important point to note here, deltas of the call and puts can be added as long as it belongs to the same underlying. Case 3, Nifty spot at 8,125. Trader has a combination of both call and put options. He has 2 lots put option here. SL no contract classification lots delta position delta. 1 8000 CE ITM 1 by 0.7 plus 1 asterisk 0.7 equals plus 0.7. 28300 pay deep ITM 2 by minus 1 plus 2 asterisk minus 1.0 equals minus 2.0. 38120 CE ATM 1 by 0.5 plus 1 asterisk 0.5 equals plus 0.5. 48300 CE deep OTM 1 by 0.05 plus 1 asterisk 0.05 equals plus 0.05. Total delta of positions 0.7 to 2 plus 0.5 plus 0.05 equals 0.75. Observations. The combined positions have a negative delta. This means the underlying and the combined option position move in the opposite direction. With an addition of 2 deep ITM pay, the overall position has turned delta negative. This means the combined position is less sensitive to the directional movement of the market. For every 1 point change in Nifty, the combined position changes by 0.75 points. If Nifty moves by 50 points, the position is expected to move by 50 asterisk 0.75 equals minus 37.5 points. Case for Nifty spot at 8,125. The trader has calls and puts of the same strike. Same underlying. SL no contract classification lots delta position delta. 18100 CE ATM 1 by 0.5 plus 1 asterisk 0.5 equals plus 0.5. 28100 pay ATM 1 by minus 0.5 plus 1 asterisk minus 0.5 equals minus 0.5. Total delta of positions plus 0.5 to 0.5 equals 0. Observations. The 8100 CE ATM has a positive delta of plus 0.5. The 8100 pay ATM has a negative delta of 0.5. The combined position has a delta of 0. Which implies that the combined position does not get impacted by any change in the underlying. For example, if Nifty moves by 100 points, the change in the options positions will be 100 asterisk 0 equals 0. Positions such as this which have a combined delta of 0 are also called delta neutral positions. Delta neutral positions do not get impacted by any directional change. They behave as if they are insulated to the market movements. However, delta neutral positions react to other variables like volatility and time. We will discuss this at a later stage. Case 5 Nifty spot at 8,125. Trader has sold the call option. SL no contract classification lots delta position delta. 18100 CE ATM 1 sell 0.5 to 1 asterisk 0.5 equals 0.5. 28100 pay ATM 1 by minus 0.5 plus 1 asterisk minus 0.5 equals 0.5. Total delta of positions 0.5 to 0.5 equals 1.0. Observations. The negative sign next to 1 in the position delta column indicates short position. As we can see, a short call option gives rise to a negative delta. This means the option position and the underlying move in the opposite direction. This is quite intuitive considering the fact that the increase in spot value results in a loss to the call option seller. Likewise, if you short a put option, the delta turns positive. Minus 1 asterisk minus 0.5 equals plus 0.5. Lastly, just consider a case wherein the trader has 5 lots long deep ITM option. We know the total delta of such position would plus 5 asterisk plus 1 equals plus 5. This means for every 1 point change in the underlying, the combined position would change by 5 points in the same direction. Do note the same can be achieved by shorting 5 deep ITM put options. 5 asterisk 1 equals plus 5. Minus 5 indicate 5 short positions and minus 1 is the delta of deep ITM put options. The above case study discussions should give you a perspective on how to add up the deltas of the individual positions and figure out the overall delta of the positions. This technique of adding up the deltas is very helpful when you have multiple option positions. running simultaneously, and you want to identify the overall directional impact on the positions. In fact, I would strongly recommend you always add the deltas of individual position to get a perspective. This helps you understand the sensitivity and leverage of your overall position. Also, here is another important point you need to remember. Delta of ATM option equals 0.5. If you have 2 ATM options equals delta of the position is 1. So, for every point change in the underlying, the overall position also changes by 1 point, as the delta is 1. This means the option mimics the movement of a futures contract. However, do remember these two options should not be considered as a surrogate for a futures contract. Remember, the futures contract is only affected by the direction of the market. However, the options contracts are affected by many other variables besides the direction of the markets. There could be times when you would want to substitute the options contract instead of futures, mainly from the margins perspective, but whenever you do so, be completely aware of its implications. More on this topic as we proceed. 11.2 Delta as a probability. Before we wrap up our discussion on delta, here is another interesting application of delta. You can use the delta to gauge the probability of the option contract to expire in the money. Let me explain. When a trader buys an option, irrespective of calls or puts, what is that he aspires? For example, what do you expect when you buy Nifty 8000 pay when the spot is trading at 8,100? Note the 8000 pay is an OTM option here. Clearly, we expect the market to fall so that the put option starts to make money for us. In fact, the trader hopes the spot price falls below the strike price so that the option transitions from an OTM option to ITM option, and in the process the premium goes higher and the trader makes money. The trader can use the delta of an option to figure out the probability of the option to transition from OTM to ITM. In the example, 8000 pay is slightly OTM option. Hence its delta must be below 0.5. Let us fix it to 0.3 for the sake of this discussion. Now to figure out the probability of the option to transition from OTM to ITM, simply convert the delta to a percentage number. When converted to percentage terms, delta of 0.3 is 30%. Hence there is only 30% chance for the 8000 pay to transition into an ITM option. Interesting, right? Now think about this situation, although an arbitrary situation. This in fact is a very real-life market situation. 8400 CE is trading at 4 rupees per. Spot is trading at 8,275. There are 2 days left for expiry. Would you buy this option? Well, a typical trader would think that this is a low-cost trade. After all, the premium is just 4 rupees per, hence there is nothing much to lose. In fact, the trader could even convince himself thinking that if the trade works in his favor, he stands a chance to make a huge profit. Fair enough. In fact, this is how options work. But let's put on our model thinking hat and figure out if this makes sense. 8400 says deep OTM call option considering spot is at 8,275. The delta of this option could be around 0.1. Delta suggests that there is only 10% chance for the option to expire ITM. Add to this the fact that there are only 2 more days to expiry, the case against buying this option becomes stronger. A prudent trader would never buy this option. However, don't you think it makes perfect sense to sell this option and pocket the premium? Think about it, there is just 10% chance for the option to expire ITM, or in other words, there is 90% chance for the option to expire as an OTM option. With such a huge probability favoring the seller, one should go ahead and take the trade with conviction. In the same line, what would be the delta of an ITM option? Close to 1, right? So this means there is a very high probability for an already ITM option to expire as ITM. In other words, the probability of an ITM option expiring OTM is very low. So beware while shorting, writing ITM options, as the odds are already against you. Remember, smart trading is all about taking trades wherein the odds favor you. And to know if the odds favor you, You certainly need to know your numbers and don your model thinking hat. And with this I hope you have developed a fair understanding on the very first option Greek, the delta. The gamma beckons us now. Key takeaways from this chapter. The delta is additive in nature. The delta of a futures contract is always 1. 2 ATM option is equivalent to owning 1 futures contract. The options contract is not really a surrogate for the futures contract. The delta of an option is also the probability for the option to expire ITM. 100. Open a ZERODHA account. Chapter 12. Gamma, Part 1. Hindu Gujarati. 12.1 The other side of the mountain. How many of you remember your high school calculus? Does the word differentiation and integration ring a bell? The word derivatives meant something else to all of us back then. It simply referred to solving lengthy differentiation and integration problems. Let me attempt to refresh your memory. The idea here is to just drive a certain point across and not really get into the technicalities of solving a calculus problem. Please note, the following discussion is very relevant to options. So please do read on. Consider this. A car is set into motion. It starts from 0 km, travels for 10 minutes and reaches the 3rd kilometer mark. From the 3rd kilometer mark, the car travels for another 5 minutes and reaches the 7th kilometer mark. Let us focus and note what really happens between the 3rd and 7th kilometer. Dash. Let x equals distance. And dx the change in distance. Change in distance i.e. dx is 4/7 to 3. Let t equals time. And dt the change in time. Change in time i.e. dt is 5/15 to 10. If we divide dx over dt i.e. change in distance over change in time, we get velocity v. v equals dx dt equals 4/5. This means the car is traveling 4 km for every 5 minutes. Here the velocity is being expressed in km traveled per minute. Clearly this is not a convention we use in our day-to-day conversation as we are used to express speed or velocity in km traveled per hour, kmph. We can convert 4/5 to kmph by making a simple mathematical adjustment. 5 minutes when expressed in hours equals 5/60 of an hour. Plugging this back in the above equation equals 4 5/60 equals 4 * 65 equals 48 kmph. Hence the car is moving at a velocity of 48 kmph, kilometers per hour. Do remember velocity is change in distance traveled divided over change in time. In the calculus world, the speed or velocity is called the first-order derivative of distance traveled. Now, let us take this example forward. In the first leg of the journey the car reached the 7th kilometer after 15 minutes. Further assume in the second leg of journey, starting from the 7th kilometer mark the car travels for another 5 minutes and reaches the 15th kilometer mark. We know the velocity of the car in the first leg was 48 kmph. And we can easily calculate the velocity for the second leg of the journey as 96 kmph. Here dx equals 8 and dt equals 5. It is quite obvious that the car traveled twice as fast in the second leg of the journey. Let us call the change in velocity as dv. Change in velocity, as we know, is also called acceleration. We know the change in velocity is equals 96 kmph 48 kmph equals 48 kmph. The above answer suggests that the change in velocity is 48 kmph. But over what? Confusing, right? Let me explain. Asterisk asterisk. The following explanation may seem like a digression from the main topic about gamma, but it is not. So please read on. If not for anything, it will refresh your high school physics. Smiley face asterisk asterisk. When you want to buy a new car, the first thing the sales guy tells you is something like this: the car is really fast as it can. Accelerate 0 to 60 in 5 seconds. Essentially, he is telling you that the car can change velocity from 0 kmph from the state of complete rest to 60 kmph in 5 seconds. Change in velocity here is 60 kmph, 60 to 0 over 5 seconds. Likewise, in the above example, we know the change in velocity is 48 kmph, but over what? Unless we answer, over what part? We would not know what the acceleration really is. To find out the acceleration in this particular case, we can make some assumptions. Acceleration is constant. We can ignore the 7th kilometer mark for time being, hence we consider the fact that the car was at 3rd kilometer mark at the 10th minute and it reached the 15th kilometer mark at the 20th minute. Using the above information, we can further deduce more information in the calculus world. These are called the initial conditions. Velocity at the 10th minute or 3rd kilometer mark equals 0 kmph. This is called the initial velocity. Time lapsed at the 3rd kilometer mark equals 10 minutes. Acceleration is constant between the 3rd and 15th kilometer mark. Time at 15th kilometer mark equals 20 minutes. Velocity at 20th minute or 15th kilometer marks is called final velocity. While we know the initial velocity was 0 kmph, we do not know the final velocity. Total distance traveled equals 15 to 3 equals 12 kms. Total driving time equals 20 to 10 equals 10 minutes. Average speed velocity equals 12 tenths equals 1.2 kmph per minute, or in terms of hours it would be 72 kmph. Now thinking about this, we know initial velocity equals 0 kmph. Average velocity equals 72 kmph. Final velocity equals, by reverse engineering, we know the final velocity should be 144 kmph as the average of 0 and 144 is 72. Further, we know acceleration is calculated as equals final velocity, time, provided acceleration is constant. Hence the acceleration is equals 144 kmph, 10 minutes. 10 minutes when converted to hours is 10/60 hours. Plugging this back in the above equation, equals 144 kmph, 10/60 hour, equals 864 kilometers per hour. This means the car is gaining a speed of 864 kilometers every hour. And if a salesman is selling you this car, he would say the car can accelerate 0 to 72 kmph in 5 seconds. I'll let you do this math. We simplified this problem a great deal by making one assumption: acceleration is constant. However, in reality, acceleration is not constant. You accelerate at different speeds for obvious reasons. Generally speaking, to calculate such problems involving change in one variable due to the change in another variable, one would have to dig into derivative calculus. More precisely, one needs to use the concept of differential equations. Now just think about this for a moment. We know change in distance traveled position equals velocity. This is also called the first-order derivative of distance position. Change in velocity equals acceleration. Acceleration equals change in velocity over time, which is in turn the change in position over time. Hence it is apt to call acceleration as the second-order derivative of the position or the first derivative of velocity. Keep this point about the first-order derivative and second-order derivative in perspective as we now proceed to understand the gamma 12.2 drawing parallels. Over the last few chapters we understood how delta of an option works. Delta, as we know, represents the change in premium for the given change in the underlying price. For example, if the Nifty spot value is 8,000, then we know the 8200 CE option is OTM. Hence its delta could be a value between 0 and 0.5. Let us fix this to 0.2 for the sake of this discussion. Assume Nifty spot jumps 300 points in a single day. This means the 8200s is no longer an OTM option. Rather, it becomes slightly ITM option, and therefore by virtue of this jump in spot value, the delta of 8200 CE will no longer be 0.2. It would be somewhere between 0.5 and 1.0. Let us assume 0.8. With this change in underlying, one thing is very clear: the delta itself changes. Meaning delta is a variable whose value changes based on the changes in the underlying in the premium. If you notice, delta is very similar to velocity, whose value changes with change in time and the distance traveled. The gamma of an option measures this change in delta for the given change in the underlying. In other words, gamma of an option helps us answer this question for a given change in the underlying. What will be the corresponding change in the delta of the option? Now, let us replug the velocity and acceleration example and draw some parallels to delta and gamma. First order derivative. Change in distance traveled position with respect to change in time is captured by velocity. And velocity is called the first order derivative of position. Change in premium with respect to change in underlying is captured by delta. And hence delta is called the first order derivative of the premium. Second order derivative. Change in velocity with respect to change in time is captured by acceleration. And acceleration is called the second order derivative of position. Change in delta is with respect to change in the underlying value is captured by gamma. Hence gamma is called the second order derivative of the premium. As you can imagine, calculating the values of delta and gamma, and in fact all other option Greeks, involves number crunching and heavy use of calculus, differential equations and stochastic calculus. Here is a trivia for you. As we know, derivatives are called derivatives because the derivative contracts derives its value based on the value of its respective underlying. This value that the derivatives contracts derive from its respective underlying is measured using the application of derivatives as a mathematical concept. Hence the reason why futures and options are referred to as derivatives. Smiley face. You may be interested to know there is a parallel trading universe out there where traders apply derivative calculus to find trading opportunities day in and day out. In the trading world, such traders are generally called quants. Quite a fancy nomenclature, I must say. Quantitative trading is what really exists on the other side of this mountain called markets. From my experience, understanding the second-order derivative such as gamma is not an easy task. Although we will try and simplify it as much as possible in the subsequent chapters. Key takeaways from this chapter. Financial derivatives are called financial derivatives because of its dependence on calculus and differential equations, generally called derivatives. Delta of an option is a variable and changes for every change in the underlying and premium. Gamma captures the rate of change of delta. It helps us get an answer for a question such as, what is the expected value of delta for a given change in underlying? Delta is the first order derivative of premium. Gamma is the second order derivative of premium. 38 responses to Gamma, Part 1. NARSIMHA. June 19, 2015 at 9:01 a.m. Sir, how to draw Mavon volume chart. What is pattern recognition and it's not? Open a ZERODHA account. Chapter 13. Gamma, Part 2. Gujarati. 13.1 The curvature. We now know for a fact that the delta of an option is a variable, as it constantly changes its value relative to the change in the underlying. Let me repost the graph of the delta's movement here. If you look at the blue line representing the delta of a call option, it is quite clear that it traverses between 0 and 1, or maybe from 1 to 0 as the situation would demand. Similar observations can be made on the red line representing the put option's delta, except the value changes between 0 to -1. This graph re-emphasizes what we already know, i.e. the delta is a variable and it changes all the time. Given this, the question that one needs to answer is, I know the delta changes, but why should I care about it? If the change in delta really matters, how do I estimate the likely change in delta? We will talk about the second question first, as I'm reasonably certain the answer to the first question will reveal itself as we progress through this chapter. As introduced in the previous chapter, the gamma, second-order derivative of premium, also referred to as the curvature of the option, gives the rate at which the option's delta changes as the underlying changes. The gamma is usually expressed in delta as gained or lost per 1 point change in the underlying, with the delta increasing by the amount of the gamma when the underlying rises and falling by the amount of the gamma when the underlying falls. For example, consider this. Nifty spot equals 8,326. Strike equals 8,400. Option type equals CE. Moneyness of option equals slightly OTM. Premium equals 26 rupees per. Delta equals 0.3. Gamma equals 0.0025. Change in spot equals 70 points. New spot price equals 8,326 plus 70 equals 8,396. New premium equals. New delta equals. New moneyness equals. Let's figure this out. Change in premium equals delta asterisk change in spot, i.e. 0.3 asterisk 70 equals 21. New premium equals 21 plus 26 equals 47. Rate of change of delta equals 0.0025 units for every 1 point change in underlying. Change in delta equals gamma asterisk change in underlying, i.e. 0.0025 asterisk 70 equals 0.175. New delta equals old delta plus change in delta, i.e. 0.3 plus 0.175 equals 0.475. New moneyness equals ATM. When Nifty moves from 8,326 to 8,396, the 8400 CE premium changed from 26 rupees to 47 rupees. And along with this, the delta changed from 0.3 to 0.475. Notice with the change of 70 points, the option transitions from slightly OTM to ATM option, which means the option's delta has to change from 0.3 to somewhere close to 0.5. This is exactly what's happening here. Further, let us assume Nifty moves up another 70 points from 8,396. Let us see what happens with the 8400 CE option. Old spot equals 8,396. New spot value equals 8,396 plus 70 equals 8,466. Old premium equals 47. Old delta equals 0.475. Change in premium equals 0.475 asterisk 70 equals 33.25. New premium equals 47 plus 33.25 equals 80.25. New moneyness equals ITM, hence delta should be higher than 0.5. Change in delta equals 0.0025 asterisk 70 equals 0.175. New delta equals 0.475 plus 0.175 equals 0.65. Let's take this forward a little further. Now assume Nifty falls by 50 points. Let us see what happens with the 8400 CE option. Old spot equals 8,466. New spot value equals 8,466. 50 equals 8,416. Old premium equals 80.25. Old delta equals 0.65. Change in premium equals 0.65 asterisk 50 equals 32.5. New premium equals 80.25 to 32. 5 equals 47.75. New moneyness equals slightly ITM, hence delta should be higher than 0.5. Change in delta equals 0.0025 asterisk 50 equals 0.125. New delta equals 0.65 to 0.125 equals 0.525. Notice how well the delta transitions and adheres to the delta value rules we discussed in the earlier chapters. Also, you may wonder why the gamma value is kept constant in the above examples. Well, In reality, the gamma also changes with the change in the underlying. This change in gamma due to changes in underlying is captured by third derivative of underlying, called speed, or gamma of gamma, or the gamma spot. For all practical purposes, it is not necessary to get into the discussion of speed, unless you are mathematically inclined or you work for an investment bank where the trading book risk can run into several dollar millions. Unlike the delta, the gamma is always a positive number for both call and put option. Therefore, when a trader is long options, both calls and puts, the trader is considered long gamma. And when he is short options, both calls and puts, he is considered short gamma. For example, consider this: the gamma of an ATM put option is 0.004. If the underlying moves 10 points, what do you think the new delta is? Before you proceed, I would suggest you spend few minutes to think about the solution for the above. Here is the solution. Since we are talking about an ATM put option, the delta must be around 0.5. Remember, put options have a delta. Gamma, as you notice, is a positive number, i.e. plus 0.004. The underlying moves by 10 points without specifying the direction. So let us figure out what happens in both cases. Case 1, underlying moves up by 10 points. Delta equals 0.5. Gamma equals 0.004. Change in underlying equals 10 points. Change in delta equals gamma asterisk. Change in underlying equals 0.004 asterisk 10 equals 0.04. New delta equals, we know the put option loses delta when underlying increases. Hence 0.5 plus 0.04 equals 0.46. Case 2, underlying goes down by 10 points. Delta equals 0.5. Gamma equals 0.004. Change in underlying equals 10 points. Change in delta equals gamma asterisk. Change in underlying equals 0.004 asterisk 10 equals 0.04. New delta equals, we know the put option gains delta when underlying goes down. Hence 0.5 plus minus 0.04 equals 0.54. Now, here is trick question for you. In the earlier chapters, we had discussed that the delta of the futures contract is always 1. So what do you think the gamma of the futures contract is? Please leave your answers in the comment box below. Smiley face. 13.2 Estimating risk using gamma. I know there are many traders who define their risk limits while trading. Here's what I mean by a risk limit. For example, the trader may have a capital of 300,000 rupees per in his trading account. Margin required for each Nifty futures is approximately 16,500 rupees per. Do note you can use Zerodha's span calculator to figure out the margin required for any F&O contract, so considering the margin and the M2M margin required, the trader may decide at any point he may not want to exceed holding more than 5 Nifty futures contracts, thus defining his risk limits. This seems fair enough and works really well while trading futures. But does the same logic work while trading options? Let's figure out if it is the right way to think about risk while trading options. Here is a situation. Number of lots traded equals 10 lots. Note 10 lots of ATM contracts with delta of 0.5 each is equivalent to 5 futures contract. Option equals 8400 CE. Spot equals 8405. Delta equals 0.5. Gamma equals 0.005. Position equals short. The trader is short 10 lots of Nifty 8400 call option. This means the trader is within his risk boundary. Recall the discussion we had in the delta chapter about adding up the delta. We can essentially add up the deltas to get the overall delta of the position. Also, each delta of 1 represents 1 lot of the underlying. So we will keep this in perspective and we can figure out the overall position's delta. Delta equals 0.5. Number of lots equals 10. Position delta equals 10 asterisk 0.5 equals 5. So from the overall delta perspective, the trader is within his risk boundary of trading, not more. than 5 futures lots. Also, do note since the trader is short options, he is essentially short gamma. The position's delta of 5 indicates that the trader's position will move 5 points for every 1 point movement in the underlying. Now, assume Nifty moves 70 points against him and the trader continues to hold his position, hoping for a recovery. The trader is obviously under the impression that he is holding 10 lots of options, which is within his risk appetite. Let's do some forensics to figure out behind the scenes changes. Delta equals 0.5. Gamma equals 0.005. Change in underlying equals 70 points. Change in delta equals gamma asterisk. Change in underlying equals 0.005 asterisk. 70 equals 0.35. New delta equals 0.5 plus 0.35 equals 0.85. New position delta equals 0.85 asterisk 10 equals 8.5. Do you see the problem here? Although the trader has defined his risk limit of 5 lots, thanks to a high gamma value, he has overshot his risk limit and now holds positions equivalent to 8.5 lots, way beyond his perceived risk limit. An inexperienced trader can be caught unaware of this and still be under the impression that he is well under his risk radar. But in reality his risk exposure is getting higher. Now since the delta is 8.5, his overall position is expected to move 8.5 points for every 1 point change in the underlying. For a moment assume the trader is long on the call option instead of being short. Obviously he would enjoy the situation here as the market is moving in his favor. Besides the favorable movement in the market, his positions is getting longer since the long gamma tends to add up the deltas, and therefore the delta tends to get bigger, which means the rate of change on premium with respect to change in underlying is faster. Suggest you read that again in small bits if you found it confusing. But since the trader is short, he is essentially short gamma. This means when the position moves against him, as in the market moves up while he is short, the deltas add up thanks to gamma, and therefore at every stage of market increase, the delta and gamma gang up against the short option trader, making his position riskier way beyond what the plain eyes can see. Perhaps this is the reason why they say shorting options carry a huge amount of risk. In fact, you can be more precise and say shorting options carries the risk of being short gamma. Note, by no means I'm suggesting that you should not short options. In fact, a successful trader employs both short and long positions as this situation demands. I'm only suggesting that when you short options you need to be aware of the Greeks and what they can do to your positions. Also, I'd strongly suggest you avoid shorting option contracts which has a large gamma. This leads us to another interesting topic. What is considered as large gamma? 13.3 Gamma movement. Earlier in the chapter we briefly discussed that the gamma changes with respect to change in the underlying. This change in gamma is captured by the third-order derivative called speed. I won't get into discussing speed for reasons stated earlier. However, we need to know the behavior of gamma movement so that we can avoid initiating trades with high gamma. Of course, there are other advantages of knowing the behavior of gamma. We will talk about this at a later stage in this module. But for now we will look into how the gamma behaves with respect to changes in the underlying. Have a look at the chart below. The chart above has 3 different CE strike prices 80, 100, and 120 and their respective gamma movement. For example, the blue line represents the gamma of the 80 CE strike price. I would suggest you look at each graph individually to avoid confusion. In fact, for sake of simplicity I will only talk about the 80 CE strike option, represented by the blue line. Let us assume the spot price is at 80, thus making the 80 strike a TM. Keeping this in perspective, we can observe the following from the above chart. Since the strike under consideration is 80 CE, the option attains ATM status when the spot price equals 80. Strike values below 80, 65, 70, 75 etc. are ATM and values above 80, 85, 90, 95 ETX ROTM options. Notice the gamma value is low for OTM options 80 and above. This explains why the premium for OTM options don't change much in terms of absolute point terms. However, in percent terms the change is higher. For example, the premium of an OTM option can change from 2 rupees to 2 rupees and 50 paise, while absolute change in is just 50 paisa. The percent change is 25%. The gamma peaks when the option hits ATM status. This implies that the rate of change of delta is highest when the option is ATM. In other words, ATM options are most sensitive to the changes in the underlying. Also, since ATM options have highest gamma, avoid shorting ATM options. The gamma value is also low for ATM options 80 and below. Hence, for a certain change in the underlying, the rate of change of delta for an ITM option is much lesser compared to ATM option. However, do remember the ITM option inherently has a high delta. So while ITM delta reacts slowly to the change in underlying due to low gamma, the change in premium is high due to high base value of delta. You can observe similar gamma behavior for other strikes, i.e. 100 and 120. In fact, the reason to show different strikes is to showcase the fact that the gamma behaves in the same way for all options strikes. Just in case you found the above discussion bit overwhelming, here are 3 simple points that you can take home. Delta changes rapidly for ATM option. Delta changes slowly for OTM and ITM options. Never short ATM or ITM option with the hope that they will expire worthless upon expiry. OTM options are great candidates for short trades assuming you intend to hold these short trades up to expiry wherein you expect the option to expire worthless. 13.4 Quick note on Greek interactions. One of the keys to successful options trading is to understand how the individual option Greeks behave under various circumstances. Now, besides understanding the individual Greek behavior, one also needs to understand how these individual option Greeks react with each other. So far we have considered only the premium change with respect to the changes in the spot price. We have not yet discussed time and volatility. Think about the markets and the real-time changes that happen. Everything changes: time, volatility, and the underlying price. So an option trader should be in a position to understand these changes and its overall impact on the option premium. You will fully appreciate this only when you understand the cross interactions of the option Greeks. Typical Greek cross interactions would be gamma versus time, gamma versus volatility, volatility versus time, time versus delta, etc. Finally, all your understanding of the Greeks boils down to a few critical decision-making factors, such as, for the given market circumstances, which is the best strike to trade? What is your expectation of the premium of that particular strike? Would it increase or decrease? Hence, would you be a buyer or a seller in that option? If you plan to buy an option, is there a realistic chance for the premium to increase? If you plan to short an option, is it really safe to do so? Are you able to see risk beyond what the naked eyes can spot? The answers to all these questions will evolve once you fully understand individual Greeks and their cross interactions. Given this, here is how this module will develop going further. So far we have understood delta and gamma. Over the next few chapters we will understand theta and vega. When we introduce vega, change in premium with respect to change in volatility, we will digress slightly to understand volatility-based stop loss. Introduce Greek cross interactions, gamma versus time, gamma versus spot, theta versus vega, vega versus spot, etc. Overview of Black and Scholes option pricing formula. Option calculator. So as you see, we have miles to walk before we sleep. Slightly smiling face. Key takeaways from this chapter. Gamma measures the rate of change of delta. Gamma is always a positive number for both calls and puts. Large gamma can translate to large gamma risk, directional risk. When you buy options, calls or puts, you are long gamma. When you short options, calls or puts, you are short gamma. Avoid shorting options which have large gamma. Delta changes rapidly for ATM option. Delta changes slowly for OTM and ITM options. Special thanks to our good friend Prakash Lekala for providing the Greek graphs in this and other chapters. 111 Responses to Gamma, Part 2. Raj.